Trideep Bhattacharya is joining us, Co-Chief Investment Officer at Equities at Edelweiss Mutual Fund. Trideep, hi, good afternoon. Thanks for joining us. So, as a mutual fund or mutual fund investor, are you using this decline to buy, or do you think this market is sensing something sinister?
First of all, thanks, Anuj, for having me on your show. And now, in my opinion, overall, I would like to just take a step back and describe what the current market setup is, and then come to what we are doing. It might make sense for the viewers. The way I would read the current market setup is basically a couple of global headwinds and a couple of local ones. The global headwinds being talks about interest rates increases globally. There's a few data points pointing towards stagflation. And the local ones include that for the first time in the last earnings season, the earnings upgrade cycle was actually tested by increasing commodity prices, particularly for the section of the market which are commodity users. And finally, I would say the Omicron issue is also having an impact. So on net balance, these all factors are resulting in markets calibrating or digesting these issues before they move forward. In my opinion, these are transient issues. This will probably go away in a couple of months' time, and the market will start focusing on the medium-term earnings drivers, which, in my opinion, are basically that we might have a capex cycle over the next 2 to 3 years. Also, heading into the elections in a couple of years' time, the government narrative on growth and the growth schemes like PLI are also likely to remain strong. So putting all of these together, what we are doing is we raised some cash during the last earnings season when we saw, as I mentioned, the earnings upgrade cycle being questioned. And we are slowly but steadily deploying it in areas where we find, interesting for stock picking grounds. Now, which are those? In my opinion, those would be select financials, industrials, indirect plays on household capex. Those would be some of the areas where we are looking to deploy money. Anuj?
Trideep, hi, afternoon. Prashant here. The market itself, I know it's just one day, but anything you're picking up, Trideep? We're down 200 plus on the Nifty. Not an iota of worry if you look at what global markets or even other asset classes are doing. So very local, the selling that's going on. Anything you're hearing, picking up, what's your sense?
My sense is, I think, on the in the post-festive season overall, from the volume growth standpoint, as things take a breather, volume growth is taking a bit of time to come back. Nothing sinister about it. And secondly, I think the number of cases that we have heard about Omicron is gradually rising. Still very small, still a few strands in Bangalore and Pune, but those would be a couple of areas. If you look at the areas that have corrected most, there would be more areas which are which have done well on back of opening up trade and now falling because people worry about potential lockdowns and this, that, the other. And some of the sectors, like, for example, IT is down today, which has done phenomenally well for us. So I wouldn't read these corrections as something really ominous. But yes, I think the winds are changing over the last 12 to 18 months. We have been used to playing the theme of opening up, base low or related earnings upgrade and stuff like that. I think for the next 6 months, you will see the market will have to stand on its 2 feet with regards to sustainable earnings drivers for the companies. So to that extent, this is a changeover phase. But having said that, nothing as in a significant amount of worry from a market standpoint.
All right.
That gives you a few pointers.
All right, Trideep, let's get further into it then. If you're going to get a bit of a correction in the near term and things could pass in the next few months, which are the sectors which you would be looking to get into? And also, given the fact that we're getting a little bit jittery, some stocks have really run ahead of themselves, what would you completely avoid?
So, as I started off with a bit of a backdrop of where the markets are, or how I read the markets, in my opinion, there is a strong chance that over the next 2 or 3 years, you will see a capex cycle. So hence, in that context, the economy facing sector should broadly do well. Now, there is obviously a whole bunch of bottom-up element to this. I'm making things simple. But if I were to look at it at a 10,000 feet level, select financials which focus on lending in the right areas, industrials, which could be automation plays, etc., and indirect plays on household capex of the real estate sector are the fertile hunting ground for us. And finally, I would say that in this era of rising commodity prices, we like strongly, or we are orienting our portfolio strongly towards companies with pricing power. I think that will be a very important dynamic for the companies that survive this correction overall. So that's the area that we are focusing on. The areas that we have been cautious on, and particularly not now, but during the result season. So we took some money out of, the typical opening up sectors because the stocks had done quite well. Like, for instance, multiplexes, hotels, hospitals, this, that, the other, which had done quite well at that point in time. Not because we anticipated this correction, but we thought that the money has been made. Of course, as time has passed, now we are looking a little better on that. But that's how I would put it.
Okay, Trideep, you have some specialty chemicals in your funds. This space has seen some correction. Of course, the market itself has corrected, but are you adding more into this space?
So, in my opinion, the broad-based theme of everything into specialty chemicals doing well is kind of behind us. Because now the commodity prices are playing an impact on which companies you own. So in other words, basically from here on, the companies that we would look to bet on more would be the areas which have the pricing power to pass on the prices to their customer and maintain margins. The last quarter actually had the impact of commodity prices on their margins, because that was the first quarter when impact came through. But only some of these companies have been able to pass on the pricing to their customers. The trick is to own those from a medium-term standpoint, because that's where the alpha would be made within the chemical sector.
Any way, so then, without naming names, how would you go about identifying those companies in the space, the chemical space?
That's where, as bottom-up investors, is where basically we have to do more detailed analysis. But a few points, few pointers that we look for in such businesses is basically the type of the business that they're in. I think if the business that they are doing it can be shifted very easily. Generally, some of these businesses can be switched in a period of 3 to 6 months. But then there are other companies where businesses can be shifted from one vendor to that of other over 1 to 2 years. So not that easy to shift. So there lies the pricing power. Secondly, of course, some of these businesses are more oriented towards higher value add areas, more into like CRAMS and this, that, the other, which are inherently where the companies are working on critical products of their customers. That is another area where pricing power could be found. So those would be a few pointers that we would look for in companies where we think pricing power could come handy.
All right, final question, Trideep. Then before we let you go, I'm looking at your portfolio and you have some real estate names. I think Brigade Enterprises is part of it. You have some of those building products companies as well. What stage are we in terms of this real estate play? We've seen a big bounce, though a distance away from what we saw a decade or so ago.
Yeah. So I think that's where I mentioned in my opening comments that we've played this building, the real estate plays quite well. The stocks have rallied quite nicely, and I think there is some more room to go. But I think incrementally, the indirect plays on the real estate sectors are looking interesting, which could be the building material stocks and whatnot. And that's where one is looking for stocks as a fertile hunting ground for us in terms of alpha creators going forward.
Okay, Trideep, we'll let you go on that note today. Then, thanks a lot for joining us. Good talking to you. The market, by the way, high on the bank Nifty.